Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jon Ferro, along with Lisa Abramowicz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app. We begin with our top story. Stocks edging out a fourth day of gains. Tracie McMillion of Wells Fargo writing this: we remain more cautious at current levels in both fixed income and equities until valuations improve and better opportunities present themselves. We expect to see broader opportunities in equities over the next 6 to 12 months. I'm pleased to say that joining us now is Tracie. Tracie, let's talk about this. More cautious on both stocks and on fixed income as well. How does a view on one asset class inform the other currently?
Good morning, John. So we are cautious on both equities and on fixed income, and we're really waiting for better opportunities to add to both of those asset classes. Right now, what we see is that at the short end of the fixed income curve, the yield is over 5%. And so you have to compare that to the opportunity in equities. And our large cap forecast for the end of 2024 is 5,200 at the midpoint. So there's not a lot of upside potential that we see in equities going out to the end of 2024. Now, 2025, we think could be a better year. So we continue to favor large cap equities. But right now, the balance between the risk reward between fixed income and equities does have us more cautious in equities, going up in quality in fixed income and staying towards the short end of that fixed income curve.
Could you clarify something for me? How do you think bonds would behave in a drawdown in equities? Would they still perform well?
Yeah, so that's a really interesting question, because over the past couple of years, what we've seen is higher correlations between both equities and fixed income. And that's because of the driver of the downturn in both of those markets, or conversely, the upturn in both of those markets. And that's been the expectations for interest rates based on inflation. And so as inflation expectations have changed, we've typically seen bond yields rise, we've seen equities come down, so both of those negative at the same time, and then conversely. What we are telling investors is that going forward, that should start to normalize as inflation comes under better control. And diversify into assets that do not have that strong positive correlation right now, like commodities and alternatives.
I'm wondering, you talk a lot about the consumer and a weakening in the consumer. How much can we get a read of that from the recent earnings, which have been pretty strong on an earnings per share basis? But you've seen revenue come in light at a number of places, including at Uber. They're talking about bookings coming in lighter than expected, expecting that to continue. They talk about Latin America bookings having to do with this. They talk about early holidays. Do you think this is evidence of just tighter competition, of price pressure by the consumer, or all of the above?
It's probably all of the above, Lisa. What we're seeing in terms of the consumer is that, and you mentioned this a little bit earlier, consumer confidence does appear to be waning. And there is a bifurcation, as you also mentioned, in the upper income quintile and the bottom four income quintiles, which have exhausted all of their pandemic savings. So really relying on just that upper end consumer now to carry the market. We'll see retail sales next week, and that will give us a further indication of whether or not consumers are continuing to spend. But some of the underlying information that we're getting out of recent data and recent reports is that consumers are pushing back on some of the price increases, and that companies are feeling less confident about their ability to raise prices. So all in all, that could be good for inflation, but we do see the consumer starting to pull back in aggregate.
I think a lot of people would agree with you, Tracie. The issue is just the speed and exactly where this is going to go in terms of the weakening. You have some people come on and say we're going to see a protracted weakening and we're going to get that true downturn. Francis Donald of Manulife talking about that yesterday. And then you have other people saying actually is just the appropriate softening to allow small caps to rally. Which camp do you fit into?
So we do think that we're going to see more of a soft patch. We think that the data last week is supporting that view that we'll probably see that soft patch, growth slowdown, labor market slowdown starting to occur in the second half of this year. So, more of a soft patch. We think there's less risk of a recession than there was in 2023. But that doesn't necessarily give us the refresh, the reset that we would need, the clearing of markets that we would need for small caps to reassert themselves. Small caps for really for decades now have seen the ranks of non-earners increasing. And that gives us some longer term concern about small caps. So there's certainly a place in the cycle to invest in them. We just don't think that the time is quite right yet.
Tracie, all morning we've been talking about the developments in the Middle East, and in your note you talk about how this could still be a risk to oil prices, which we've seen pull back quite significantly. What kind of upside do you think we can see in the oil market?
Yeah, we have a price target on oil of between $80 and $90 a barrel through the end of this year, but we could see towards the upper end of that target range if we were to see oil trade restricted more in the Middle East. We did get good inventory numbers here in the U.S., and certainly U.S. producers could ramp up production, but that will probably take a little bit of time. And in the interim, we could see some supply constraints that would push prices higher. And don't forget about OPEC being able to bring on more supply as well. So we don't see oil prices necessarily skyrocketing, but we could see certainly the upper end of that range, and we think that would again put pressure on markets because it could imply inflation.
If that were to be the case, say $90 a barrel, where would you potentially want to shift in your portfolio?
Yeah, so we have already shifted towards commodities with an overweight there. Again, the non-correlation, we like that about commodities. We've certainly seen precious metals performing well, gold in particular, and we think that oil does have some upside from here. So, a commodities position we think is probably a smart thing to do at this point.
Crude a little bit lower on a session this morning. Tracie, always wonderful to hear from you. Tracie McMillion there of Wells Fargo. Fed President Neil Kashkari urging caution, adding the Fed will likely keep rates on hold for a, quote, extended period. More Fed speak on tap with Jefferson, Collins and Cook all speaking today. Janet Henry and the team at HSBC expecting the Fed's first cut in September and expecting the ECB and BOE to move in June. Janet joins us now for more. Janet, some people might say September has become the new June. What is the risk that December becomes the new September and pretty soon?
Yeah, there's always risks where markets are concerned, as you well know. It's not so long ago that markets were pretty convinced that the first rate cut was going to be in March, and then it briefly went right to the end of the year. And you're right, September for us is the new June, but you'll also know that back in December we were saying June. So it really will depend on the data. But as Powell keeps telling us, it's the totality of the data. Yes, they need to see further improvement on inflation, but they don't need to wait until they get back to 2%. But the urgency with which they will feel the need to act will depend on all of the data, including the labour market. So it may be that, the progress on inflation is relatively modest, but if they see more that scares them in the labour market data, that could cause them to act. But if in December we're still at unemployment less than 4%, still getting payroll prints of 200,000, and inflation, core PCE, is still above 2.5%, then what's the urgency?
It's pretty impressive. It's not where we thought we would be even 3-4 months ago. Janet, let's talk about September and not the economic data. Can we just talk about the politics briefly? You're not alone on September. Other people have that marked on the calendar as well, including Ellen Zentner over at Morgan Stanley. I think the natural question for us to ask is the politics relevant here? Going into the election in November, is September still an option that's open to this Federal Reserve?
I think every meeting is open to the Federal Reserve, because I think in anyone's scenarios, including the most likely scenario for any FOMC member, is that the next move in rates, and any scenario is still on the table, the next move in rates will be a small one. We're talking about a 25 basis point move in rates is what's going to happen. Now, while that is consequential, because hopefully it will be the beginning of a sequence of rates, even if it's not every quarter or every meeting, maybe it is a bit more intermittent, they will take the decision when it is appropriate based on the data. I don't think it will be, oh, we've got to wait until after the election, we can't be too political. Yes, a lot of them will be having that thought at the back of their mind, but it will be about what is most likely to settle inflation at least a bit more confidently back on track towards the 2% level, even if we never really get there, without inflicting more damage than is necessary in terms of what's happening in the labour market.
But Janet, whether or not they come out and they say, we don't plan to be political, that's going to be the optics. So what's the bar in the data they need to see to almost feel comfortable about taking that move, knowing that many are going to view it through this political lens?
Well, we get back to the data. You've got to remember, in the last set of projections that we had back in March, what was in the Fed forecasts for core PCE for the end of 2024 was 2.6. We're at 2.8. We know this is a bumpy ride for inflation, but just as everyone got overly excited at the end of last year on a few downside surprises to the inflation releases, they've got really, really hawkish early part of the year when inflation surprised for 3 months by about 0.1, on a monthly basis for that kind of period. So I think what they do need to see now, it seems, to really pull the trigger is get a core PCE print that probably is more like 2.5. As the headline figure, but they will also need further evidence in the data, slower growth, slower employment growth in particular, and the wage numbers. That's by no means the most important factor, but the more 0.2s we get on monthly inflation and the lower the payrolls release, that's probably what we do need to see to get that September rate cut.
Say September comes and goes and they don't make that cut. Do you think they push it to December, or there is a chance that November could be a live meeting?
I think it would be unusual to cut in an election month. In fact, when we looked back at this, and certainly when I spoke to other previous FOMC members, they could only remember one meeting whereby the timing of an election, and I think it was a midterm election, actually influenced the Fed's outcome. And actually it was under Greenspan ahead of a midterm elections. But the next move straight after the election was a 75 basis point move. So it was really consequential when you're delivering a rate rise of that kind of magnitude. So I think November will be unlikely. For me, it really is a case of we either go in September or we wait until December. But I wouldn't rule anything out.
One of the most interesting aspects of your forecast is that you now call for 25 basis points of rate cuts this year. It was 75 basis points previously, but you keep your forecast for 75 basis points next year. Do you think that we're heading toward a higher neutral rate than you previously expected?
Well, I've long been highlighting over the last few years that we are moving towards a higher neutral rate. Obviously, the movement on the dot plot and the longer-term dot from the FOMC has edged up from 2.5 to 2.6. But I really get the impression from various FOMC members that they actually think it's more like about 3%. But I guess what we've got in our projections is the idea that policy will need to stay relatively restrictive. And I think this is what you might hear from more central banks. You could potentially hear something like that from the Bank of England tomorrow. The idea that rates can be cut a little bit and still be restrictive. If we're still at 4% Fed funds, which we are on our forecasts, by the end of 2025, arguably that is still restrictive to ensure an ongoing disinflationary process. We don't have core PCE at 2% by the end of 2025.
Janet, well said. Appreciate the clarity as always. Janet Henry there of HSBC breaking down the Federal Reserve. Mandy, you call this the persistent kink
in the VIX futures curve. Can you walk us through it?
Yeah, so we've been observing this since the beginning of the year, where the October future, VIX future, is trading at a premium to the September by about 2 to 3 points. And that's unusual because, A, we're still many, many months away from the election. If you look at this point in the 2020 cycle, there was only about a 1 point difference between the September and October contract back then. So a lot more volatility being embedded this early on in the cycle. And then the second thing I mentioned before was, the November, if you look at the November future, it actually doesn't show expectations of persistent volatility. People are expecting it to be quickly resolved, which I think is, interesting given the candidates involved.
Just can broaden out a little bit this concept of volatility. A lot of people have been saying, oh, the market's getting more volatile. We look at a lot of the overall market metrics. They're not really getting all that more volatile.
Right.
But you look at specific stocks, and they're whipsawing. We're seeing that just this morning. How do you put that together?
Actually, we have a great metric to exactly illustrate that. So this has been a key feature of the markets over the past, I would say, 18 months, is that while index volatility or macro volatility has been muted, single stock volatility has not. So if you look at the stock level, exactly to your point, there's been some wild swings at the stock and the sector level. So in other words, dispersion of stocks have been high in terms of performance, while because of the low correlation, index returns have been muted. So if you look at the VIX, that's low. If you look at our dispersion index, DSPX, that's actually near historically high levels. And that kind of exactly illustrates that dilemma.
Mandy, given we know what happened after the 2020 election, where is this conviction coming from traders to say, actually, there's little fear of a contested election?
So I think you got to separate out, because even in 2020, right, and we saw headlines about, is there election fraud, and obviously one candidate not conceding. But even in 2020, volatility came in very rapidly in November. So I think in terms of realistic path to a contested election, I think the hurdle is actually quite high. And I think that's what investors are really kind of focusing on. It's like you may get noise, you may get headlines, but at the end of the day, there is a process in place, and investors at this point still trust that process. And that's why you're not seeing that persistent kink in the curve.
You've explored this a little bit as well. How does this compare to previous elections, not just 2020, but going back even further? Is this normal?
So what it's being priced in, I would say at this point in the cycle, is higher than what we see at this point in the cycle. But if you look at how the VIX actually performs in October, it's actually underpricing relative to some of the more recent cycles. So both 2016 and 2020, we saw more significant jumps in volatility in the month of October than what is actually currently priced in. So I think 2016, 2020 averaged about 10-point increase in the VIX. So right now, 2 to 3, I think as we get closer to the election, we'll probably start to see that actually increase.
How does this stack up with what you would advocate for? So it's Steve Eisman right, basically. Tariffs on China, big deal. He said this about the Inflation Reduction Act. You might get changes. There might be talk of repealing it. We might move on that for a single day. But at the end of the day, nothing will happen. Would you advocate for the same thing? Is that how you view things?
So in terms of fiscal policy, I think what is important to focus on is that in the state of government, the state of politics nowadays, really to get fiscal policy through, you really need to have a clean sweep. Right? And that's the kind of what people are focused on. And I think part of the reason why this may be a little bit less volatility being priced in relative to how it actually performed last cycle is that there's just more of a less chance of potential clean sweep by either the Democrats or the Republicans. And that's what you really need in order to enact, a significant fiscal policy in the market.
So divided government means there's going to be gridlock, but at some point they need to contend with the Trump-era tax cuts. They will expire in 2025. Do you expect some of them to be extended at the very minimum?
So I don't have an expectation in terms of the fiscal policy side, but I would say, that would obviously have an impact in terms of, the rates market, and that's where a lot of people are focusing on. But the big driver, in the rates market, obviously, is the Fed and monetary policy, and that is still front and center for a lot of investors. So we'll see as we get closer to the election, obviously the outcome of the election, what happens to those, Trump tax cuts. But so far, it's still very much focused on inflation and the Fed and potential Fed rate cuts.
Let's put a bow on things just briefly. The spike in volatility in April. Yes. You've explored this. Was it a one-off? How do you guide sort of that conversation at the moment?
Yeah, sure. So in so much as the April sell-off was driven by rates, I think it's important to recognize that the balance of risk has shifted when we talk about rates, right? We've been talking about rates higher for longer for a very long time, but now the focus is really on the longer part of that. right? How much longer? Which, when you think about it, it's actually vol dampening because it's talking about rates remaining unchanged for longer versus before when we were talking about rates higher for longer, the focus was very much on higher. How much higher, right? How much higher inflation can go. The right tail when it comes to the rates distribution was much more significant. So to me, what stood out in April is that even though we did get a sell-off in the market, volatility was actually really muted in the rates market. If you look at TLT implied volatility, for example, it doubled last October during the rate sell-off. But this time around, it actually went up very, very modestly, and is now actually currently back down to a one-year low. So the more contained reaction that we're seeing in the bond market, I think, has spilled over into the equities, and that's why VIX is again back to 13 handle.
Interesting, Mandy. You're one of the best at this, and we always enjoy catching up with you. Thanks for being with us.
Thank you,
Mandy Xu there of CBOE.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.